Lender Absa posted a marginal rise in interim profit as it benefited from higher interest rates, which was partly offset by higher impairments. Consumers remained under pressure from high inflation and interest rate increases in the latest reporting period. This led to a fall in headline earnings of 17% in South Africa, where local factors such as load shedding, high unemployment, poor economic growth were added to the mix of the global economic downturn. As a result, total credit impairments surged 60% to 8.3 billion rand. I spoke to the bank's financial director, Jason Quinn, for more.
When we were together in March, we predicted a tough half for our market in South Africa, our main market, and certainly that's what we saw. I think Absa today delivered against what it committed to in the first half of the year. Pretty resilient set of performances there and greater portfolio diversification. In particular, our businesses outside South Africa doing quite nicely and our corporate investment bank doing very well. And that was offset by some increased bad debts in South Africa and mostly our consumer businesses. So a resilient set of numbers and numbers I think we're all quite proud of for the half.
Let's focus in on that total credit impairment charges surging 60%. Perhaps you can give us a little bit more detail for the viewers here in terms of where these large increases stem from.
Look, very much on the back of rapidly rising interest rates in South Africa. Interest rates went quite high quite quickly, and the central bank describes them today as restrictive, which we would agree with. So certainly the increase in bad debts was on the back of that. It was predicted on our side, so we were in line with what we thought would occur. In some of our products, like home loans, we had a very low base in the first half of last year. We call it a loan loss rate. It was 19 basis points up to 60. Similarly in cards and personal loans. But we used the opportunity to build significant coverage against bad debts, and I think that'll make us quite resilient into the next year. In fact, also, Nastasia, we actually guide for that to improve in the second half quite substantially.
You mentioned rapidly increasing interest rates, and we are starting to see that. But from the data that you're looking at, perhaps on a daily, what's your sense of your customers' ability to keep up with these rapid increases, to keep up with that pace?
Yeah. Nastasia, we're hopeful that the worst is behind us. In other words, if we look at all the factors that we observe, including inflation and the stance of the central bank in South Africa as well towards that, we actually think we've reached the peak of this rate rising cycle. And in fact, consumers can potentially look forward to rates starting to come down from the first quarter next year in a slow and steady basis. So there's a light at the end of the tunnel, so to speak, with respect to that factor, which is a very, very material factor in people's monthly installments. And then, of course, at Absa, our intention is always to keep people in their houses and in their cars. So to the extent that we need to make alternative arrangements over this period and look at forbearance, or let's call it payment relief, to the extent people have the willingness to pay and the ability to pay, we'll certainly support them through the tough times that we're all experiencing.